Let's start. Write a short note on seed capital. What do you mean by seed capital assistance? No? Okay. So generally seed. Okay. What is seed capital? Suppose you're going to start your business. You need initial funds, correct? That is the minimum funds you require. Automatically, the people are ready to fund you. That's called seed capital. So when the business is growing, you need money. So money will be ready to support your project. That's called seed capital assistance. In this case, 2 times the question has been asked to institute. Okay, 5 and 10. Seed capital assistance scheme designed by IDBI, Industrial Development Bank of India, for professionally or technically qualified entrepreneur who lack financial resources. See, I'm a technically qualified person, professionally qualified person, but I don't have any financial resources. I don't have money. But somebody can able to assist me, no, so that my project will be successful. In this case, that's what IDBI Bank has suggested. So that's why they started with the new idea of seed capital assistance. So done by the IDBI banks to all professionals who lack financial assistance. So initially, what is eligibility? So project cost. It should not exceed 2 crores. It should not exceed 2 crores. So the project cost should not exceed 2 crores. So the maximum assistance under this scheme will be, that's it. So the project cost should not exceed 2 crores. The maximum assistance under this scheme is supposed to be 50% of the promoters required contribution. Number one, that's true. What is the project cost that the entrepreneur is going to invest? Maximum 2, not exceeding 2 crores. Number one, 50% promoters required contribution. You have to contribute 50%. Suppose your project is 40 lakhs worth. So 20 lakhs, the promoter has to contribute. Or 15 lakhs, whichever is lower. That's it. That's a condition. Automatically, either 50% of promoter contribution or 15 lakhs, whichever is lower, that is the amount ready to fund you. That's maximum assistance. Okay, maximum assistance. Suppose 40 lakhs promoter contribution. 40 lakhs into 50%. Imagine so 20 lakhs. 20 lakhs. Or whichever is lower. So 15 lakhs is a lower amount. Maximum contribution by the IDBI bank to the entrepreneur, 15 lakhs only. Similarly, what about interest rate? So these kind of seed capital assistance carry interest rate of 1% per annum for the first 5 years. 1% per annum for the first 5 years, and increasing rate thereafter. That's it. Initially, first 1% per annum. 1% per annum. Next, first 5 years. Per annum 1%. See, imagine, not 13%, not 12% interest, not per month. 1% per annum. Suppose 20 lakhs, 15 lakhs they providing 1%, which is supposed to be 15,000. That's it. 1 year you have to pay interest only 15,000. That's it. For first 5 years. Later on, increasing thereafter. So IDBI will have an option to charge interest rate as such as may be determined by on the loan because of the loan, depends on the loan total. Suppose the profitability of the company has been increased. Automatically, the interest rate also increased. That's it. So I'm ready to fund you at 1% per annum interest rate. Suppose your profitability increases, my interest rate also increases. That's it. So by the way, duration of loan also can be extended. Right? Repayment schedule. Right? Repayment schedule is always fixed, depending on the repaying capacity of the business. But initially, moratorium period up to 5 years. Sorry, sir, first 5 years, we won't disturb you. But next 5 years onwards, you have to stabilize yourself, repayment has to be started. But anyway, it's going to be agreement between the entrepreneur and the IDBI bank. That's it. So first 5 years, moratorium, which means we are flexible. We never charge you. We are not supposed to disturbing you. That's it. Okay, that's initial up to 5 years. That's a point. Next question. So 2007 paper 8 and 12. It's going to be deep discount bonds. What do you mean by deep discount bonds? That is nothing but zero coupon bond. That's called nothing but zero coupon bond. Zero coupon bond. What do you mean by zero coupon bond? Zero coupon bond means zero interest, 0% interest, which means company going to issue deep discount bonds or zero coupon bonds are nothing but issued at par, issued at discount, but matures at par, issued at discount. Company issued at discount, bonds are issued at discount, and matures at par, matures at par, which means suppose the company going to raise the loan 90 rupees. So they have to repay 100 rupees. So 90 rupees discount, repayment is going to be 100. That's it. So what happened to the 10 rupees? So that the company has to pay extra, right? It is not interest, that extra money the company ready to pay. That's it. Okay, right. For 90 rupees, the company borrowing loan, repayment of the company is 100 rupees. Every year they won't pay any interest. That's called zero interest. For 10 rupees, the company has to pay extra, maybe 5 years period down the line. So automatically it is going to be 5 years period or 3 years period, just like this. Okay, so 5 years period. That's it. Right. Next, so these bonds are sold at a discounted rate. That's it. And on maturity face value, it is paid to the investor. That's it. In such bonds, there is no interest paid during the lock-in period. That's true. I told you, 5 years is a maturity period. That's it. 5 years, I'm not supposed to pay any interest, but after 5th year, I'm going to pay 100 rupees. 90 borrowed, 100 repayment. But 10 rupees is going to be extra amount I'm ready to pay. That's it. But during the lock-in period, okay. So automatically, I'm going to pay extra amount, but no zero. Then there is no interest. Suppose when bonds are sold in the stock market, the difference realized between the face value and the market value is called capital gain. That's it. Okay. Suppose when the bonds are sold in the stock market, the difference realized between the face value and the market price is called capital gain. That's it. That's called capital gain. Okay, it's very, very important. And the bonds are sold in the stock market. Okay. Okay. Suppose when the bonds are sold in the stock market, automatically, what is the face value? Nominal value. Nominal value. What is the market price? The difference is called capital gain. Very important line. Okay, right. Suppose if it is sold in the stock market, our capital gain will be arising. The difference between the face value and the market price is called capital gain. Initially, first IDB in 1992, they introduced these deep discount bonds. Deep discount price of 2,700. So IDB, the investor got a bond with the face value under 1 lakh rupees. Discount price 2,700. So the bond appreciates to its face value for the maturity period of 25 years. Maturity period of 25 years. That's it. Okay. Similarly, the investor also can withdraw the investment periodically after 5 years. That's it. Automatically, first time they introduced face value 1 lakh, discount price 2,000, maturity period, see the line, 2025 years. After 25 years, you can repay the loan. That's it. Okay, right. A simple discount price of 2,700 rupees, which means 97,300 rupees is a borrowed money by the company. 97,300 is a borrowed money. After 25 years, they're going to repay only 1 lakh. So this is a gain for the company. See, they're not supposed to pay interest for 25 years, correct? No? This is the borrowed, this is repayment. For such a way, see how much gain the company going to have. Right? That's advantage of zero coupon bonds. But alternately, the investor can withdraw from the investment period after 5 years. After 5 years, suppose you contribute to the company 1 lakh, every 5 years, you can withdraw the money periodically. Periodically, you can withdraw the money. Sir, I need 30,000. Okay, withdraw. Sir, I need 40,000. Okay, withdraw. Similarly, that's it. After 5 years, the investor can able to withdraw the money. That's it. So the capital appreciation is charged to tax at capital gain. That's it. It is lower than the income tax rate. Right? So the deep discount bonds are considered to be safe, solid, liquid instrument. That's it. Okay, right. So it's going to be considered safe, solid, and liquid instrument. The best rating big crisis. That's it. So because even if you're going to issue any bonds, you need to be rated by the credit rating agencies. Correct? No? So that automatically the investor money will be safe. So crisis will ensure the investor money is very safe. So they can rate the companies AAA, AA plus, AB, just like this. Okay, right. So company borrowed the money, they have to repay. The company has to get certification price. So then when the company can able to issue zero coupon bonds. So they are going to be rated like crisis. So 2008 paper. Discuss the features of security premium notes, SPN. What are the features of security premium notes? Number 1, security premium note is issued along with detachable warrant and is redeemable after a notice 25 period of 4 to 7 years. That's it. Now, security premium note is issued along with a detachable warrant. It is redeemable after notice period of 4 to 7 years. That's it. What is detachable warrant? The warrant can be detachable, given to you. After 7 years, it can be redeemed. That's it. So security premium note. That's it. It is issued along with the detachable warrant, period 4 to 7 years. So these detachable warrants are converted into equity shares. Within the time frame, it can be convertible. Premium note along with the detachable warrant will be converted to equity shares. So the warrant explains give the holder right to apply for get allotment. What is the warrant has been why the warrant has been attached along with the premium note? Because anytime the warrant can be detached and it can be used for conversion into equity shares. Which means why the warrants attached to SPN? The purpose, it just gives the holder the right to get allocation of equity shares as per condition as notified by the company. Above, whoever may be having a security premium note with a detachable warrant, anytime they can apply for equity shares. That's it. So 2000 paper is going to be concept of IDR. What is IDR? So IDR is an instrument. It is an Indian rupee. It is an instrument in Indian rupee. That's it. The form of deposit receipts created by a domestic depository. In India, there are two depositories, NSDL and CSDL. Depositories. Automatically, IDR is instrument denominated in Indian rupees. The form of depository created by depository participants. That's domestic depository. Right. So those have been raised with SEBI. So India, there are two people have registered with SEBI. One is called Central Depository and the one is called National Depository, NSDL and Central and the National. Two people have been registered with the SEBI in the form of depositories. I will just against the underlying equity of issuing company to enable foreign companies to raise funds in Indian securities market. That's it. Which means American company coming to India, they're going to invest in Indian rupees. It is called IDR. Indian company going abroad to raise the funds is going to be ADR. American company or any foreign company, so they want to raise Indian stock market. Any foreign company, they are coming to India to raise money in Indian stock market. So for them, we have to issue IDR. In the sense, what happens is IDR means in India, the domestic company, so they have to issue this IDR, which has been already created by domestic depository of any foreign company. So they're going to raise funds in Indian stock market. So they can come automatically through IDR route. That's it. Okay. So for this, first it should be deposit receipt to be created. It should be created and it should be registered with SEBI. Okay. Against the underlying equity of issuing company. That's the idea. Okay. A foreign company coming to Indian stock market to raise the funds in Indian rupee, it is called IDR. That's it. So before that, so automatically some depository has to be created. It should be a domestic deposit to be created. They have to be all registered with SEBI. What are the legislation governing? What are the laws regulating IDR in India? Central government notified in companies, that is Registration of Foreign Company Rules 2014, Section 390 of Companies Act. SEBI issued guidelines for disclosure with respect to IDRs. Okay, already SEBI has been issued guidelines for IDR. So IDR condition already they given guidelines. Okay, right. Automatically, so they are also notified model listing agreement as created. So already they entered between exchange and the foreign issuer. That's it. So specifying continuous listing requirements they have to fulfill. That's it. So already they entered between exchange and the foreign issuer. Okay. Already listing agreement created and entered between the exchange and the foreign issuer. Already created. That's it. So there are a lot of laws also required to create IDR. In simple layman language, okay, SEBI guidelines has to be followed, company rules has to be followed automatically. So foreign companies, they're going to coming to India to raise funds in the Indian stock market through depository route, depository in rupee denominated. Okay, so that the issue is called IDR. That's it. Same question has been several times asked. Next one. So 2008 paper is going to be external commercial borrowings, ECB. External commercial borrowings, ECB. What is ECB? It's an instrument used in India to facilitate the foreign money by Indian corporations and PSU. That's it. Automatically, so ECB is an instrument used in India to facilitate the access to foreign money by Indian corporation and PSU. Very important. That's it. It is going to be used only in India. By the way, I can get foreign money. External commercial borrowing, which means Indian company get the money from abroad. That's it. And PSUs, public sector undertaking, going to get the money from abroad. That's it. ECBs include commercial loans. They are including commercial loans. That's it. So I'm borrowing loans, the commercial loans. Bank loans I can get. Buyer's credit. Sir, can you give me 3 months credit so that I can repay? Supplier credit. Security instruments. Floating rate notes. Fixed rate notes. That's it. It can be available from non-resident lenders also. It can be available from non-resident lenders also. With a minimum average maturity of 3 years. So minimum average period of 3 years. That's it. That's the point. Okay. So floating rate notes, fixed rate bonds, and it will avail from the non-resident lenders with a minimum average maturity of 3 years. That's it. Next one, third one. So borrowers can raise ECBs. Borrower can raise ECB. So internationally recognized sources like international banks. I'm a borrower. I'm going to raise funds, ECB. Through international banks, I can raise ECB. International capital market, I can raise ECB. Multilateral financial institutions such as IFC, ADB, I can raise ECB. Export credit agency, I can raise through. These are the sources I can able to borrow ECB. I can raise ECB through these tools. Suppliers of equipment, foreign collaboration, foreign equity holders. So these are the ways in which sources available. Automatically I can raise ECBs. That's it. External commercial borrowings can be accessed by 2 routes. One is called automatic route. Another one is by approval route. Approval means government and RBI control. There are 2 routes ECB can be accessed. One is automatic route. Number 2, approval route. Who is going to approve your ECB? I'm going to get the loan. Who is going to approve? RBI or a government. That's it. Under automatic route, no RBI, no government approval required. But under approval rate, you need to get the approval from the RBI and the government. That's it. Automatic approval, no need to take approval from RBI, Reserve Bank of India and government. In case of approval route, to get the ECB, you have to get approval from RBI and government. That's it. So company registered under Companies Act and NGOs, even though engaged in microfinance activities, they are eligible for the automatic route. That's it. They are eligible for automatic route. Okay, that's true. Because there are a lot of companies and NGOs, microfinance institutions, they are eligible for the automatic according to government guidelines. But whereas financial institutions, banks, exclusively infrastructure projects, export finance, especially in textile steel sector participation, restructuring package, so they have to get approved. Who is going to have an automatic route? Who is going to have approved? So NGOs, companies registered under Companies Act, microfinance institution, they can get the funds ECB through automatic route. No government, no RBI approval required. But there are certain financial institutions, there are certain banks, exclusively they're dealing with infrastructure and export finance. So they're going to participate in the textile and the steel sector. What route they have to go? They have to go with approved route. That's it. Next one. Name the various financial instruments dealing with in the international market. That's it. Okay. Name any four financial instruments. That's it. International financial market. That's it. An example for this: European bonds, Euro bonds, floating rate notes, ECB, fully hedged bonds. Example. See the other financial instruments. International financial market is available. You can raise funds. Euro bonds available. Floating rate notes available. External Euro commercial paper is available. Fully hedged bonds available. That's it. Example 1. Euro issue. What is Euro issue? So Euro issue means issue listed on the foreign stock exchange. What is Euro issue? Issue listed in the foreign exchange, not in Indian stock exchange, in foreign exchange. So which means we are going to raise foreign currency in international market. Example ADR and GDR. What is ADR? American Depository Receipts. What is GDR? Global Deposit Receipts. Indian companies going to tap American capital market through ADR route. Indian companies going to tap global market through GDR route, Global Deposit Receipts. Recently, Infosys also raised GDR. They raised GDR, Global Deposit. They raised it. Similarly, they raised ADR also. So, in Infosys company recently raised ADR, American Deposit Receipts, which means Indian company going abroad in the foreign exchanges, they raised money through foreign currency. That's called ADR. So, American market we targeting ADR, global market we targeting GDR. That's it. So, foreign currency convertible bonds. That's it. First one is called Euro issue, right? Number 2, Euro bonds. What is Euro bonds? Long-term loans raised by the entities enjoying excellent credit rating. That's it. So Euro bonds and long-term loans raised by the entities enjoying excellent credit rating. That's it. Very important. Euro bonds is nothing but we are getting money from European market. Simple. Euro. That's it. That's what Euro they call. European market is called Euro market. Here long-term loans, the company going to get. Any company have excellent credit rating, they can go and raise the funds to European markets. So they are the debt instruments. In which country they are denominated the currency of the country in which they are issued. So where they issuing it, that currency only is denomination. That's it. Where they issue, that is a denomination currency, right? So they are issuing in the form of bearer, rather than in the form of registered bond. That's it. Okay, right. Which means they do not contain investor's name, the country of origin. That's it. European bonds is a bearer bond. Does not need to be registered bond. It's a bearer bond. Anybody having a bond, they can raise money. That's it. No name has been entered. No, do not contain. What is bearer check? No name. That's called bearer check. Similarly, what is bearer bond? No name of the investor has been mentioned. That's it. That's called bearer bond. Registered bond means name is required. Bearer bond, no name required. That's it. Number 3, foreign bonds. Foreign bonds are debt instrument denominated in a currency which is foreign to the borrower. That's it. So automatically it's a debt instrument in a currency foreign to the borrower. That's it. It's called foreign bonds. Say okay, right. Automatically suppose I am in India. We are dealing Indian rupees. I'm raising the funds in America. America is a foreign money. It's a foreign to me. American currency is a foreign currency to me. That's it. Automatically I am a foreigner to the borrowing. Yes, I'm a foreigner. Exactly. Because I'm in India. I'm a foreigner to the borrowing. That's it. Where the denomination being foreign currency only. Where it is going to be sold? It is sold in the country of that currency. Where it is sold in America. That's it. Number 4, fully hedged bonds. So fully hedged bonds are foreign bonds devoid of risk of currency fluctuation. That's it. Devoid of currency fluctuation. Risk of currency fluctuation. Right now. So fully hedged bonds are foreign bonds devoid of risk of currency fluctuation. It's called fully hedged bonds. That's it. Which means no fluctuation. Nothing is going to be affected by way of fluctuation, which means the bonds are safe. Loss in the one hand, compensated by the profit in the other hand. Loss in one hand, compensated by the profit in the other hand. It is going to eliminate the risk by selling the entire streams of principal and interest payment in the foreign market. That's it. So automatically, so we are going to selling the streams of principal interest payment in the foreign market. That's it. It is eliminating risk. Yes, it is eliminating risk. That's it. So fully hedged, loss in one area, compensated by the profit in the other area. It's called hedging. Okay. Automatically there is a divide of risk of currency fluctuation. No risk at all. No risk at all. Eliminated risk. That's hedging. So I'm going to hedge the funds, which means I'm eliminating the risk. I'm investing in one area, I have risk. So one area risk, another area I have benefit. It is going to be compensated. It's called hedging. So automatically, in order to eliminate risk, I'm going to invest by selling entire streams of principal and interest payment in the foreign market. Principal interest payment in the foreign market. That's it. Okay. So I'm completely eliminating risk. Automatically, where I'm going to selling principal interest payment in the foreign market. That's it. So if you're going to eliminate risk, automatically you have to sell in the foreign market. So by the way, your principal interest will be safeguarded. That's it. Similarly, floating rate note. That's it. Okay. So we are just listing out some of the international market financial instruments. Correct? Euro issue, euro bonds, foreign fully hedged bonds, floating rate note. That's it. The floating rate note means it is going to provide foreign currency at a rate lower than the foreign loans. Okay. Our floating rate notes are they are in the foreign currency. Interest rate will be lower than the foreign loans. Issued a period of 7 years. Okay. Interest rates are always flexible, going to reflect the prevailing exchange rate. It is going to be adjusted, reflect the prevailing exchange rate. That's it. Okay. That's called floating rate note. That's it. So floating rate note means provide foreign currency at a rate lower than the foreign loans. They are issued for a period up to 7 years. That's it. Next one. It is called floating rate note. Euro commercial paper. That's it. What is euro commercial paper? So they are promissory notes with a maturity period of less than 1 year. Euro commercial papers are promissory notes with a maturity period of less than 1 year. This is called euro commercial paper. So these are the unsecured instruments issued by a corporate body. Any company can issue ECP, European commercial paper, they can issue. It is unsecured instrument, correct. Company borrowing loans, but no security attached. So who are the people really issue euro commercial papers? Banks, insurance companies, fund managers, especially they design in the US dollar. That's it. So these are the people normally issuing euro commercial papers. Okay. Who are the people? Bankers, insurance companies, fund managers. These people are always issuing euro commercial paper in US dollars. So foreign currency option. That's it. Foreign currency option is right to buy and right to sell. That's it. I have a right to buy. Right. What is option? Right to buy. What is option? Right to sell. That's it. Okay. Buy option, put option. Call option, put option. Call option means right to buy. Put option means right to sell. Similarly, foreign currency option also, I have a right to buy, I have a right to sell. Either future market or foreign market. Specified currency, that's it. Specific foreign currency, I have a right to buy, I have a right to sell. The future market, foreign market. Similarly, here also hedging is going to be happen. By the way, my financial economy is going to be adjusted. Here also provide hedging. It also provides hedging against the financial and economic risk. That's it. It is called foreign currency option. What is foreign currency? Futures. Future market, if you're going to invest now, you need a lot of money. What is foreign market? I told you earlier. So after 6 months, I'm going to repay the amount with this amount. But the dollar rate can be fixed now. It's called foreign market. That's it. That interest rate or dollar rate can be fixed now. Foreign rate. Can you pay right now? It's called spot rate. Can you pay right now? For the prevailing market situation, market condition. Can you pay right now? Spot rate. Can I pay after 6 months? Can you fix the rates today? Forward rate. So those dollar rates we can fix today. So after 6 months, this is the money I'm going to pay in dollars. That's it. Are you okay? Right. Future forward market. Can you pay the money right now? In spot market. Right. What is foreign currency futures? A foreign currency future is a right to buy, a right to sell, a sum of foreign currency, a fixed exchange rate on a specific future rate. It is an alternative to forward contract for hedging of exchange rate. That's it. Okay. It is an alternative. What do you mean by this? It is an alternative to forward contract. That's it. Okay. Automatically, it is an alternative to forward contract for hedging of exchange risk. That's it. Define the concept of ADR. Discuss the concept of ADR. That's it. Discuss the concept of ADR, American Deposit Receipt. Okay, ADR. What is ADR purpose? I told you earlier. Indian company going America, raising funds in American currency is called IDR. It's called ADR. Indian companies going abroad, especially in America, raising funds in a foreign, in American stock exchanges in American dollar, it's called IDR. IDR. That's it. What is ADR? That's a meaning. Okay. Apo, any deposit issued by an Indian company, it is an Indian company. See the line is going to be Indian company. It's Indian company in USA, in USA, in USA. Indian company deposit receipts issued by Indian company in USA in ADR. That's it. It has to be in accordance with SEBI guidelines, in accordance with SEC guidelines. In India, they used to call SEBI, controlling the capital market. Correct? No, Security Exchange Board of India. In US, we used to call SEC. So Security Exchange Commission. That's it. In US, Security Exchange Commission only, they're going to take care of this ADR. That's SEC. All stock exchanges in the US market regulated by SEC. ADR is generally created by the deposit of securities outside a company with a custodian bank in the country of incorporation of issuing company. That's it. That's it. ADR is generally created by the deposit security outside company with a custodian bank. That's it. Of incorporation if issuing company. That's it. The custodian bank informs the depository in USA. That's it. So that ADRs can be issued. ADRs are generally dollar denominated. So generally they traded in the way the US company has been traded. Same way. That's it. How the US companies are trading US market, same way the ADR can be traded. Okay. So ADR can be generally created outside the company or custodian bank, okay, or deposit in USA. ADR can be issued. That's it. Similarly, ADR can be traded just like US share markets, US securities. ADR can be traded either by trading existing ADRs or purchasing shares in the issued home market. Okay, right. So ADRs can be created based on the availability and market condition also. Where the ADRs are various, ADR can be issued, at the ADR can be money can be issued in foreign currency, foreign market. That's it. So it can be traded in the secondary market or New York Stock Exchange to depository trust company without involvement of foreign brokers or foreign custodians. Okay, purchasing shares in the issuer's home market, the new ADRs are created. That's it. Indian company going in American stock exchange, they issuing ADR. That's it. In foreign currency. The same question again they are asking ADR and GDR. American deposit and GDR. That's it. What is GDR? It's a global deposit. It is basically a negotiable certificate in dollars represent non-US company publicly traded local currency equity shares. That's it. Any non-US company, so they can able to issue. That's it. Negotiable certificate in US dollar, but issued by the non-US company in publicly traded local currency equity shares. That's it. Okay, that's called GDR. A non-US company issuing in dollar in publicly traded local currency. That's it. It is a negotiable in certificates. Instead of IDR, ADR, it is also negotiable certificate denominated in US dollar by a non-US company. So publicly traded INR in INR. So here it's going to be in US dollar. It is going to be in Indian currency, local currency. Suppose in INR. That's it. It is traded in INR, ADR. It is traded in US dollar. It is GDR. That is the only difference. Non-US company only issued. GDR issued by non-US company. ADR issued by non-US company. But it is in terms of dollar. It is issued in terms of rupee. That's it. Where are they going to issue? Publicly traded. Here also publicly traded. That's it. That's the basic idea. It is created when local currency shares of Indian company are delivered to the depositors local custodian bank. That's it. Indian company shares delivered deposit local custodian bank. Where is the local custodian? Maybe in US. Where is he in? He is in US. Okay. Automatically deposit local custodian bank, it is delivered to them. Against the deposit bank issues deposit receipt in US dollar. Automatically, so my Indian company, I'm going to issue GDR now, and I am going to be registered with my depository custodians, depository bank. So they're going to be issued with the foreign person. Okay, these are the foreign depositories. So automatically, I'm going to connect with my depository. My depository going to have a link with the foreign depository. So by the way, GDR can be issued. That's it. Any non-US company can issue GDR, but it should be in US dollar. It should be publicly traded. So automatically issuing companies depository having connection with the traded countries depository. That's it. Wherever traders, they have a depository connection. That's it. It is issued in European capital market. It is in especially American market. Very important. GDR in European market. ADR generally in American market. It is non-US stock exchange. It is especially in American stock exchange. All over the world, it can be traded, but it is traded only in America. That's the issue. That's the issue. Next one, what is off-balance sheet financing? Off-balance sheet financing, which means any company takes some assets on lease basis. Lease basis. So I'm not going to become owner of the assets. I'm going to take the asset on lease basis, which means it does not become owner of the asset. It does not become owner of the asset. It is making full use of these assets. Ultimately, own those assets if lease agreement has a terms and conditions to this effect. That's it. Terms and conditions to this effect. So the company is now the owner of the assets taken on lease. That's it. Okay. So automatically, what is the condition? It does not become owner of the asset. Apo, I'm going to have asset, but I'm not the owner of the asset. But I'm going to take the asset on lease basis. Lease basis. I'm going to use the asset fully. Ultimately, I can own the assets. Once the lease agreements comes to an end, I have option either I can buy the asset or not to buy the asset. That's it. But I'm not the owner of the assets. Once I'm taken the goods, the assets on the lease, I'm not the owner of the asset. That's it. So these assets does not show on the balance sheet. That's it. It is understatement of assets. Sometimes lead to some wrongful estimation of balance sheet figure. That's it. But automatically, leased assets are non-appearing on the balance sheet. Therefore, off-balance sheet financing. Off-balance sheet, outside the balance sheet. Our lease assets are off-balance sheet financing. Any assets lease. I'm the owner of the assets now. It is in the balance sheet asset side. Leased assets. I'm not the owner of the assets. Automatically, it is supposed to be in the off-balance sheet financing. Off-balance sheet financing. That's it. Okay. 2009 paper. What is financial planning environment? Financial planning environment. That's it. So what is financial planning? Every day you need to have a plan. That's it. Whatever you planned a year ago, the same plan cannot apply now. Correct? No? Is it true? Correct. Because environment changes. What is worthwhile 10 years ago, it is going to be worth less. What is worthwhile 10 years ago, it is going to be worth less. About business is a dynamic nature. So financial planning to be made and it has to be implemented. All the dimension aspects of financial planning have undergone some basic changes in these years. That's it. Whether laws, rules, regulations, investors' attitude, awareness, everything, company responsibility, accountability, liability, international finance, exchange, everything. So our financial planning means there is a lot of changes in the laws. Yes, 100% changes in the laws. Rules are changed. Yes. Regulations of the country to country change. Yes. Year to year change. Yes. Investor activity changes. Yes. Every moment it is going to be changed. Awareness change. Yes. Company responsibility change. Yes. Accountability factor, liability factor, international financial system, exchange and others. Yes. Therefore, it's a dynamic nature. Dynamic nature. Every time you have to go for financial planning. It is on a daily basis changing. National laws are changing. International laws are changing. Exchange rates are changing. Interest rates are changing every day. Export-import policy, exim policies are changing. That's it. Automatically, you have to take adequate measure, the more efficient and effective. I told you what is efficiency and effectiveness yesterday, strategy management. Right? No? Effective efficiency means use of resources in optimal way. Effective means within the time frame you have to complete. That's it. 2000 paper, commercial paper is a source of financing. That's it. Let's see what is meant by commercial paper. What do you mean by commercial paper in source of financing? So commercial paper is nothing but financial instrument, right? A company promises to pay certain sum after a period. Okay, sir, I'm ready to pay this money after a period. It's called commercial paper. Naturally, the issue value is less than the maturity value. The issue price is always less than the maturity. The issue price always less than the maturity value. That's it. Issue price always less than maturity price. Very, very important. Okay, issue price always less than maturity price. The CP is not covered by any security. CP is not covered by any security. Life is short between some days to some weeks. That's it. CP is not covered by any security. It is always short between some days to some weeks. That's true. Okay, which means collateral free. Collateral free. There is no collateral. So we are ready to raise CP, but there is no collateral required. Within some days, CP may be some days to some weeks. Repayment can be started in a days or even can be started in some weeks also. Very short period. So CPs are collateral free, not covered by security. It is short term between some days to some weeks. It is transferable. Yes. It can be used as ordinary currency or money. Yes. Maturity can be flexible to suit the requirements of the company. Right. Similarly, it is transferable 100% true. It can be issued, it can be used as an ordinary currency, yes. Maturity flexible. I told you, some days to some weeks. It's a very short period of life. By the way, CP can bring some money to the company. If other instruments are not able to raise funds, we can bring funds in through CP. So maturity can be delayed by replacing the old CP with a fresh CP. That's it. Okay. So maturity can be delayed by replacing old CP with fresh CP. That's an important area. So it can be delayed by, okay, suppose sometimes, sorry sir, old CP tomorrow going to be matured. Automatically it can be replaced by new CP. Any new CP is issued, old CP can be replaced. By the way, that's it. So that maturity period can extend. So the company can raise funds at a lower rate than from other sources of finances. That's it. So company can able to raise funds at a lower rate than from other sources of finances. That's very, very important. Right? So company can raise funds. Nominal rate of interest paid by the company on CP is going to be less than what is paid to the bank for raising same amount of money. That's it. Okay. Right. Above, the company can able to raise funds at a lower rate. Company can able to raise funds at a lower rate than that from other source of finances. Right. If a company can raise funds at a lower rate, that's the issue of CP. Right. So normally what you pay to the bank will be higher. What you are paying to the CP is a lower. Interest rate paid by the company in terms of CP will be lower than the interest rate paid to the bankers. That's it. It's a short-term financing, very short-term, few days to few weeks. That's it. So limitation of financial planning. So what is planning? Related to future. Suppose future is uncertain, then how can you predict it? That's a limitation, negative point. So actually, based on the fact past only, the planning we can require. Definitely, it is impossible to predict what is going to happen next day. There is no foolproof planning. It's impossible to have a foolproof planning. Always there is a limitations are there. That is true with the financial planning as well. The first and foremost limitation of financial planning. The forecast provide basis of planning. The forecasts are always doubtful. It is always basis of planning. It is always doubtful. That's it. Okay. More the time, the length of the forecast, the more doubtful it becomes. That's it. The length of the forecast will be higher. Doubtful it is. So forecasting time will be higher, risk will be higher. Doubtful will be higher. That's it. Okay. Length of the forecast will be higher. Automatically, progressively, doubtful also higher. Risk also higher. So planning will be always certain. It's become factor. Certain circumstances, not always. You know exactly how much capex to be spent. Yes. How much money you have to go? You're going for a paid every year as installment. Yes, that is certain. So to a certain extent, it is certain, but not always. Okay. So the planning of payment is always based on the fact only. So based on the fact only, the planning of payment can be started. The same question has been raised again and again. I told you, minimum duration of CP is going to be 7 days to few days to few weeks. CP can be in terms of 5 lakhs, multiple of 5 lakhs. Okay. As for issue CP, the company interest should be more than 5 crores. This is eligibility. CP should be multiple of 5 lakhs. 5 lakhs into 1, 5 lakhs into 2, 5 lakhs into 3, just like this. What is the period of CP? 7 days to 1 year. Commercial paper. Who can issue CP? A company whose net worth is 4 crores, 5 crores above, they can issue CP. CP can be neither redeemed before maturity nor can be extended beyond the maturity. That's it. Sorry, no redemption. No extension. But new CP can be issued. By the way, you can go for maturity. Okay. It can be neither be redeemed. Sir. And maturity time, you have to repayments to be started. That's it. Neither be redeemed. That's it. CP issue request credit rating of P2 from CRISIL and A2 from ICRA. Any company they're going to issue CP, they need to be credit rating by the ICRA or CRISIL. If you're going to be ICRA credit rating, you need P2 credit rating. If you're going to be credit rating by ICRA, it's going to be A2. That's it. CRISIL P2, ICRA A2. So this is basic. The same question repeated. Right. What is FCCB? So foreign currency convertible bonds, FCCB. What is FCCB? So there are always convertible bonds, foreign currency convertible. Can you convert foreign currency in Indian rupee? Yes, that's called FCCB. Any foreign currency bonds are convertible in nature, they are called FCCB. That's it. Initially, they are in the issued currency, other than domestic currency. FCCBs are issued by the corporates, rising funds in foreign currency. That's it. FCCB is always issued by the corporates in rising funds in foreign currency. So they have a lot of inherent features. Okay. So it is always a good play for the issuers and the investors. Investors also feel okay. Issuing people also, they feel okay. So that's what is a preferred instrument, always FCCB. It is unsecured. Any company going to raise FCCB, it is always unsecured. Fixed rate of interest it carries. Anytime you can convert into equity. That's advantage. Fixed number of securities of bonds can be converted into equities of the issuer company. This company issuing FCCB, the same company can issue the equity shares also. Okay, it can be convertible. That's it. Interest and redemption is payable in dollars price only. If conversion option is not exercised, that's it. Interest rates are very low in Indian domestic standards. Very low, very low interest rate we have to pay. That's it. It is always denominated any freely converted foreign currency in US dollar or Japanese yen. The company can issue FCCB in terms of foreign currency only. Japanese yen, Chinese yuan, okay, or in maybe in Malaysian ringgits, Singapore dollar or US dollar, just like that. Maturity FCCB 3 to 7 years. Same time, the option is lies with the bondholder. Bondholder, you can redeem the investments, or you can convert into equity shares before maturity, pre-determined price. Either you redeem it anytime, you can go for redemption. You can get back money anytime, or if you otherwise, you can able to convert into equity shares also. That's it. FCCB also just gives the investor option coupon rate payments anytime, the coupon rate payments. That's it. So bonds, no, it always carrying some interest rates. The purpose of FCCB, low interest rate, number one point. Convert anytime it can convert to equities. Number two, lower interest you have to pay. Option can be given to the investor. Anytime you can convert into equities, just like convertible debentures, no. So convertible bonds. FCCB does not require any collateral. FCCB always low cost source of borrowing. The fund can be raised through issue of FCCB. Nowadays, companies can able to raise the money through FCCB also. So various expansion plans, capex, they are doing through FCCB only because it carries low interest rates. Option given to investor anytime they can able to convert into equity shareholders. If a company can raise the funds from the investor at a low rate of interest in foreign currency, convertible bonds. That's it. Low interest, anytime the investor can able to convert into equity shares. That's it. So how the funds are going to be used rising through FCCB? It can be used for any capex, any capital expenditure for the corporates. Same question, LOC, they are asking letter of credit and commercial paper CP. What is letter of credit? LOC. It is by the banker helping the customer to obtain credit from the customer supplier. That's it. From the supplier, right? See, my supplier is not testing me. I'm a receiver. My supplier is not testing me. Immediately, I can get a LOC from the banker. I just hand over to the supplier. Now the supplier have a full confidence automatically, so they are ready to supply. It is normally credit a customer, okay, whereby banker helps a bank customer to obtain the credit from his customer supplier. That's it. Okay. It is automated banker and the supplier. Once LOC is given by the customer's banker, supplier will be very happy. That's it. When the bank open LOC in favor of the customer on some specific purchases, the bank under responsibility to honor the obligated customer and the customer fails to. Suppose I'm receiving import. I'm doing import now. My exporter in Singapore. But exporter is not testing me. He says, sir, please go to your banker and get the LOC. Then we ready to export. My Singapore client says. Automatically, I'm go to the banker, sir. My Singapore client, my Singapore person, supplier, he wants LOC from the banker. Can you issue LOC? Okay, I'm ready to pay some amount. LOC issued. By having LOC, automatically the supplier instrument. That's it. Automatically, what is the purpose of LOC? The supplier will be very happy. Your money will be safe. Supplier money will be safe. Even the customer fails to do, banker will repay the money to the supplier. That's the purpose of LOC. I already told you CP, right? CP, I told you, so it's a money market instrument, unsecured, short period, net worth required, and it's going to be few days to few weeks, right? CP. Same multiple of 5 lakhs we can raise. Minimum period of CP 7 days to maximum 1 year. If you're going to issue CP, your net worth should be more than 5 crores. CP can neither redeem before maturity, nor it can be extended beyond the maturity. Okay, before maturity you cannot redeem. You cannot extend the maturity period also. Exactly on the maturity you have to repay. That's it. Before maturity you cannot redeem. After maturity you cannot extend also. That's the purpose. For issuing any CP, you need 2 credit rating things. One is from Pricel PR2 and from ICRA you need A2. That's it. 2 things. What is sweat equity shares? Company issuing to the directors, employee is called sweat equity. Section 2, subsection 80 Companies Act Sweat equity shares means generally shares issued by the company to the directors. Sweat. They are working hard. Employees are working hard. So the company issuing the directors and the employee at a discount price. Other than cash. Because of the director employee, so the company have an idea, know-how. Because of the director employee, company all the rights are available. All the nature of intellectual properties or value addition through the directors and the employees only. The company getting all the value addition through the directors and the employees only. So that's what sweat equity shares are issued by the company to director employees. So what a condition of sweat equity shares? It is authorized by special resolution. Number one, if a company have a special resolution, so the company can able to issue sweat equity shares. Number two, the company has to specify number of shares, the current market price. How many shares I'm going to issue to this class of directors, this class of employees? How many shares the company going to issue? The company has to pass resolution. Number two. Similarly, at least 1 year from the date of issue. So since the company started commence business, that's it, as elapsed, which means after 1 year period, the company can issue sweat equity shares. Since the inception, since the incorporation, at least the company has to wait for 1 year. After that, the company can issue sweat equity shares. Elapsed since the company is commenced to business, minimum 1 year period required. After that, company can able to issue sweat equity shares to the director and employees because they are just giving for the company all the value additions. Because of them only, company has just reached to such a height. All sweat equity shares are listed on the recognized stock exchange in accordance with SEBI rules and regulations. If not listed, you have to follow company rules 2014. So they are regulated by the SEBI if they are listed. Otherwise, if not listed, you have to follow company rules 2014. That's it. What is lease financing? I told you there are 2 types of leases. One is called operating lease and financial lease. I already told you. What is financial lease? Which means maximum risk carried by the finance. Maximum risk carried by the lessee. Maximum period of usage of the instrument with the lessee only. At the end of the lease period, the lessee has the option either he can buy the instrument or he can reject it. That's it. The one which is not a financial lease is called operating lease. For example, so 3 months I need instruments, so 5 months instruments, so operating lease. That's it. So these kind of instruments are called lease financing. That's it. So instead of buying the asset, I'm just controlling the asset. I'm using the assets. That's it. This means I'm getting rented assets. That's it. It is contract between the owner and the owner of the asset. Lessor, user asset, lessee. That's it. So lessor gives the lessee all the rights. So please use assets over a period of time. That's it. The contract is related with the terms and conditions of the agreement. That's it. An operating lease is a short-term lease. The lease period being less than the useful life of the asset. That's it. So financial lease otherwise called lessor for amortization of the entire cost of investment plus expended on the capital outlay. That's it. Okay. This lease is usually for longer period, non-cancelable. That's it. Financial lease cannot be cancelled. Operating lease can be cancelled. So generally, financial lease can be signed for leasing the land, leasing the building, leasing of machinery, leasing of fixed instruments. That's it. So these are the ways in which leasing can be done. Leasing land, leasing the building, leasing the machinery, leasing fixed instruments. What are the functions of SEBI? Some functions of SEBI. SEBI have a lot to do, especially promoting the security market and the matters therein connected with that. Number one, they have to regulate the business of stock exchanges. Number two, so they have to register and regulate all the stock brokers, share transfer agents, bankers, underwriters, portfolio money, investment advisors, other individuals. They have to be get registered with the SEBI and regulated by the SEBI. These people have to be get registered and regulated by SEBI. So registering and regulating the working of depositories. How the deposit is going to work today? SEBI just giving the guidelines. They're going to be custody of securities. So nowadays everything in the demat account, correct? No, your shares in the online only demat account. Who is having custody? Who is going to control this? This deposit is only. That's it. Even credit rating schemes, including mutual funds, custodians of securities, working depositories. So they are all regulated by the SEBI only. Ultimate point of SEBI, they're going to prohibit the fraudulent and unfair trade practices. So they're going to prohibit fraudulent and unfair trade practices related to security market. Right? Any unfair trade practice I have now, it is going to be prevented by the SEBI only. That's it. Anytime it has the power to call the periodical return. That's it. It comes under the category of SCRA. It comes under the category of SCRA. That's it. Next, what is the role of finance manager nowadays? The finance manager role is so complex and so demanding. He has to play a huge role, especially the competition is going to be global nature nowadays because of technology developments, because of volatile financial prices, uncertainty of the economy, laws are ever changing, ever changes, and because of ethical concerns, that's it. If a shareholder have a shareholder activism is there, automatically financial manager has a huge role to play. That's it. Number one, he is interested in investment planning, financial structure. His areas of interest are financial planning, investment planning, M&A, restructuring, merger acquisition, restructuring. So two companies are going to merge now. He is having huge role to play. Working capital management is involved. Performance management, risk management, treasury management, portfolio management, investor relations. These are the areas he is focusing. Risk management, one of the important area because he has to minimize the risk. Treasury management, he is the custodian of cash. So for treasury management, portfolio, different portfolios handling, different shares is handling. Investor relations he has to maintain the corporate governance. That's it. So Indian finance professionals are respected across the globe today. So they're going to occupy top level positions, including MNC. That's it. What do you understand by ECB, external commercial borrowing? That's it. ECB, already we've seen ECB, external commercial borrowing. That's it. The same question repeated. What are these also already we took it. What are three basic financial decisions? Investment decisions, especially related to capital budgeting, whether to invest or not invest now in crores, working capital decisions. So their long-term decisions are called capital budgeting. Short-term decisions are called working capital management. That's it. Number one. Number two, financing portion decision. That's it. Okay. So financial mix or capital structure. That's it. Which means risk and trade-off should be there. Number three, dividend. So these are the three decisions the company finance decision, the company manager and finance manager has to take. Dividend. So when we have to declare the dividend, when the dividend to be declared by the directors, how much you have to pay preference shareholders. So these are the areas that we have to focus on it. Next important thing, international financing is called forfeiting of financial service, which means it's a financial transaction, purchase of receivable from exporters by a forfeiter. Say Tata exporting to China 100 crores worth. Those Tata exports to China going to be purchased by the forfeiter. So Tata's export to China is going to be 5,000 crores. Those 5,000 crores instruments are going to be purchased by the forfeiter. Upon now the forfeiter take all the risk, sir. Your transaction to China is going to be 5,000 crores. Okay, we ready to buy the receivables from China. We ready to pay. Okay, your receivables to China. And your debtor is China. Okay, we'll take care of China. If you want any money, we ready to pay you 5,000 crores. We support you some amount. Okay, hereafter you don't have any connection with China. What are the amount you are going to collect from China? Be ready to pay right now. These people are called forfeiter. A purchase of receivables by the exporter are called forfeiter. That's it. Because they take all the risk associated with the receivables. Same time is going to earn some margin also. So purchase receivable exporter by the person is called forfeiter. That's it. Similarly, purchasing export receivable at a discount by paying cash. For example, I told you 5,000 crores Tata's export to China. It will take 1 year for Tata to collect the money from China. But instead of forfeit, say, sir, I'm ready to pay at 5% discount. Can you offer? So I'm ready to pay minus 5% right now to you. Okay, right now 5% discount. After 5% discount, what are the money you're going to collect from China? I'm ready to pay right now to you. But China receivables, we will take care. Don't worry, we will take care. What are the money you're going to collect from China? We pay right now. It is called forfeiting. That's it. Okay. Purchasing exporters receivable is called forfeiting. That's it. It is always at a discount price. Once you purchase receivable is going to happen, it is a part of importer to pay the debts. That's it. Same time, it is usually guaranteed by the importer's bank. That's it. So the forfeiter frees the exporter from credit. Similarly, risk of not receiving the payment also from the exporter. Okay. See, this means once the forfeiter take care of receivables from the exporter, automatically the risk transferred to forfeiter 1 year after. The exporter will not be involved. So forfeiter frees the exporter from credit year after. Risk of not receiving payment from the importer, purchase goods on the credit. Year after, forfeiter will take care of Chinese payments. Tata will no longer connect it from Chinese payments. Tata hereafter will not collect any payment from Chinese. Forfeiter only will collect all the payment from Chinese. Automatically, the exporter will be totally freed. Totally freed. That's it. A forfeiter make a payment to the exporter some amount by purchasing the receivables from importing country. That's it. That's the point. Okay. Apo, the receivables became a form of debt instrument. It can be sold in the secondary market. That's it. Okay. About what kind of forfeiting service? In simple. Exporter sells the goods to the importer and deferred payment 3 to 5 years. 3 to 5 years. Exporter sells the goods to importer 3 to 5 years. So automatically the importer does series of promissory notes. Okay, so don't worry, sir, I'll make a payment. Importer draw promissory note to exporter. So don't worry, your payment is safe. Automatically I'll pay the money with interest, along with interest. So promissory notes are available and guaranteed by the reported international bank. Importer's banker. Importer's banker giving the promissory note. So the money will be safe. My money will be safe. That's it. The exporter now says the notes to the forfeiter. After importer banker assured promissory notes guaranteed by the international banker. So those promissory notes are handed over to the forfeiter at a discount without recourse. Once forfeited, that's it. Hereafter, Tata will not recover any money from China. It is up to the forfeiter to take care of Chinese money. That's it. So forfeiter will make a payment to the Tata. Tata will not recover any money from China. Hereafter, China from forfeiter will collect all the money from China. That's it. Without recourse. Without recourse. That's it. Forfeiter may hold these notes till maturity. Till maturity. That's it. What is forfeiting? Are promissory notes. Promissory notes. So promissory notes are always available to importer's bank. That's true. It is available anytime the notes can be returned to the importer. Importer. Yes, because who is having notes now? Forfeiter only. Anytime notes can be available to the importer's banker. The available notes can be returned to the importer. Available notes can be sent to the exporter also. Exporter also. Similarly, okay. So notes can be sold at a discount to the forfeiter. That's true. That's true. 100 crores means 5% discount. Sold to the forfeiter. Hereafter, all the money will be collected by the forfeiter from China only. At the same time, forfeiter will make a payment to the exporter, Tata. Exporter can get finance also. Forfeiting is nothing but finance. They're getting from forfeiting. Correct? No? Correct. So forfeiter can hold the notes till maturity and sell the short-term paper either to a group of investors or investors. That's it. What is the purpose of bank credit, OD? Why we need OD, overdraft? You want to run your business, you need bank credit. Overdraft is one of the bank credit given by the bank to the customer. CC also one of the bank credit given by the bank to the customer. LOC, letter of credit. Working capital loan. Fund term loan. Sir, can you pay me? So I'm going to buy one machine. What is the cost of machine? 1 crore. Can you give me a loan? Term loan. That's it. So I'm going to repay the amount within 5 years time, 7 years time. Bill purchase, bill discounting. So these are the things bank credit available. OD, bank credit. CC, bank credit. LOC, bank credit. Term loan, bank credit. Either working capital or fund interest. Bill purchase, discount. So I have a bill receivable. Discount the banker. That is also bank credit. I have bill received from the customer. I have bill received from the customer. I hand it to the banker. That's also bank credit. That's it. So GDR already explained it. That's it. So GDR do not carry voting rights. It is traded in the international market only. The investor can get fixed income. That's it. So GDR can be converted into underlying shares. That's it. That's it. Okay. Last one. Mr. X deposits 1 lakh at the beginning of each of the year. First year. First and third. First and third 1 lakh. Second 2, 4, 5 1 lakh. So beginning of the first year, beginning of the third year 1 lakh. End of the second year, end of the fourth year, end of the fifth year 1 lakh. Find the discount value of investment at the end of third year. Discount rate of 10%. 10%. Okay. So PV ratio 10%. It is not related to this one. So my idea only I'm telling. Last one. 10%. 0, 1, 2, 3, 4, 5, 6. That's it. So discount rate 1 by 1.1 whole power 0, 1. 1 by 1.1 whole power 2, 1 is equal to 0.909. Anyway, we're going to see this idea. We're going to study it separately in budgeting, capital budgeting. 1.1 whole square. Present value of B factor is going to be 0.826. Just like this going on. See, for example, okay, this value is given. Now, what is the present value of all the money now? Discount price. So, beginning of 1 year, I invested 1 lakh. 1 lakh. 1 lakh. Okay, 1 lakh I'm invested. End of second year, 1 lakh plus 1 lakh, 1 lakh beginning of first year, 1 lakh, third year 1 lakh, 31 lakh. So extra of 1 lakh beginning of each year's 1 and 3. Each of years, year 1 and year 3, beginning. End of second year and fourth year, fifth year, it just deposit 1 lakh, correct? So automatically what happened means, so 1 year is depositing 1 lakh, 1 lakh. His money will become end of the 3 years, 1,30,100. Because how is going to be future value? Future value, which means 1.1 whole power 3. So it is not related to source of finance, some general idea. Compound interest model, compound amount model. So we investing 1 lakh, end of third year, this money will become 1.1 whole power 3, 10% interest rate, 1.331, 1 lakh into 1.331, down 3310. Suppose end of year 2 is investing 2 lakhs, 2 lakhs, 2 lakhs. Okay. Next one. Reason. Okay, just a minute. And 1 lakh at the end of each of the years, 245. Okay. End of first year, end of third year. Where is third year? Fixed deposit 1 lakh at the beginning of year 1 and year 3, correct? 1 lakh at the end of year 2, 4, 5, correct? Discount investment, the end of 3 only they are asking. Okay, end of 3 only they are asking. Right. Okay, right. Now, see the table. This is line 0, 0. So this is 3. This is 3. 2, 1, 1, 1, 2, 3. 1, 2, 3. So beginning of the year 1 lakh. Beginning of the year 1 lakh. I'm going to invest. The question is about end of 3 only. End of 3 only. Right. 1 lakh. Automatically 1 lakh. It is going to mature in 3 years. 133 end of 3 years. Year 2, end of year 3, end of year 2, end of year 2. Again 1 lakh. One more 1 lakh I'm going to invest. One more 1 lakh I'm going to invest. Correct? No. End of year 2. Right. In this case, sorry, it is not 2 lakh. It is going to be 1 lakh only. End of year 2, his investment is going to be, okay, his investment is going to be already is 1 lakh invested. End of year 2, one more 1 lakh is going to invest. One more 1 lakh is going to invest. That money become, okay, sorry, it is not 2 lakhs, it is 1 lakh actually. They do the printing mistake here. End of year 2 is investing only 1 lakh. 1 lakh. It is 1 lakh only, 1 lakh only. It is not 2 lakh 20,000. 1 lakh into 1.1. So 1 lakh into 1.1, year end of year end. One more year only pending. So it's going to be 1 lakh 10,000. 1 lakh 10,000. That's it. Next one. End of 3 investing. Don't think about end of 3. End of 4, year end 4. End of 4, how much going to invest? 1 lakh. That is after 3 years. You are crossing 3 years. Come back to before 3 years. Now you're in the 4th year. Can you come back to 3? Present value factor. 1 by 1.1 is going to be 0.909. So 1 lakh into 0.909, 90,900. That is correct. End of year 5. End of year 5 also investing 1 lakh. Come back to year 3. End of 1 lakh, your investment is 1 lakh. Now, can you come back to year 3? Then your investment value is going to be 1 by 1.1 square. Present value factor. This is future value. These two are called future value. These two are called present value. That's it. 0.86. So end of 5th year, your investment is 1 lakh. Then end of the 3rd year is going to be 82,600. That's 82,600. So please add these values, right? It's not a correct option, these values only. So 1,300, 1 lakh 10,000, 90,900 plus 82,600. That's it. It means 4,16,600. So the money you're going to invest in beginning of the year, next 3 years, it is going to earn some interest. Automatically your money become 13310. End of year 2, you're going to invest 1 lakh. Next 1 year, money is going to get interest. The money become 1,10,000. End of year 4, you're going to invest 1 lakh. Can you come back to year 3? It become 1 by 1.1. End of 4th, you're going to invest 1 lakh. Now, what is the end of 3rd year value? 90,900. End of 5th year, you're going to invest 1 lakh. Now, what is the value at the end of 3 years? 82,600. That's it. Can you add all the money? So your discount price is going to be 4,16,600. That's it. So there is a printing mistake, not 2 lakhs. 1 year 2 only is investing 1 lakh only. They put 2 lakhs. Sorry, it's incorrect. The last one. What is the discount price of 10% per annum? End of year 1 of investment 2 lakh. It is to be made end of year 2, and 30,000 made immediately. 30,000 made immediately. That's it. Okay. So question is discount price 10%. End of year 1, I'm going to invest 2 lakhs. End of year 1, I'm going to invest 2 lakhs. That is to be made at the end of year 2. And 30,000 made immediately. That's it. So 30,000 you have to invest now, immediately, and 2 lakhs end of year 2. Correct now? So 30,000 you have to invest now, and 2 lakhs end of year 2. That's it. End of year 2. Now we are at the end of year 1. End of year 1. See, year 0 today, year 1, year 2, year 2. That's it. Now we are in year 1. Now we are going to invest in 30,000. In year 2, we are going to invest 2 lakhs. 2 lakhs. Correct now? It is not 30,000. It's going to be 3 lakhs, I think. 3 lakhs. Okay. Correct. Not 30,000. 3 lakhs. It is 3 lakhs. Okay. 3 lakhs. It is 3 lakhs. So automatically 3 lakhs. We are going to invest. We are in year 1 now. We are present in year 1. 3 lakhs. 3 lakhs become end of year 2. 3 lakhs into 1.1. That is 3,30,000. Future value. That's it. So now we are in year 2. Correct now? Year 2. Can you come back to year 1? It become 2 lakh into 1 by 1.1. Can you come back to year 1? 1 by 1. It become 1,81,818. That's it. Okay. Which means year 1 becomes future value. Year 2 becomes present value. What is the future value of 3 lakhs? 3,30,000. What is the present value of 2 lakhs? 1,81,818. Can you add? You will be getting 5,11,818. That's it. So anyway, these things are we going to study in capital market. Just idea only they doing. That's it.